Good morning, everyone. Thank you for attending the 2013 Annual Primary Drivers of Midwestern Job Growth Program. John Lennon once said, work is life, you know, and without it, there's nothing but fear and insecurity. I have a feeling that he said this right after he left the Beatles and was wondering what to do with his life. But if we time warp back to 2009, I think that most of us in this room can relate. We were all pretty fearful and insecure when the unemployment rate rose to 10%, a level not seen since the early 80s. Something I read about. I was probably the most fearful that my parents would take away my Atari game console in 1982. But I digress. Back to the present. The current unemployment rate is around 7.7%, a dramatic improvement since October of 2009, but still high compared to the 4.5% rate seen just over 5 years ago. So how do we feel about growth in the coming year? Sales of previously owned homes and construction of new houses has accelerated in February, highlighting the strength in residential real estate that's helping propel the U.S. expansion. Purchases of existing properties increased to a 5 million annual rate, and that's the strongest since November of 2009, and housing starts rose to 915,000 pace annually. That's pretty good news, right? But consumer sentiment tumbled to its lowest in over a year in early March as more Americans were dissatisfied with government economic policies and fewer expectations to see improvements in growth or the labor market. But hold on, U.S. manufacturing output bounced back in February, the latest signal of strength in an economy that is showing clear momentum despite the headwinds from government austerity. Factory production rose 0.8% last month after falling 0.3% in January. The gain was broad-based and double what economists had expected. However, despite improvements in confidence, CFOs revealed significant concerns about the U.S. economy, including a 33% chance the U.S. will slip back into recession within the next 12 months. But sales at U.S. retailers climbed twice as much as forecast in February, showing improving job prospects are helping consumers and the economy overcome higher taxes and gasoline prices. Well, we have an incredible roster of experts for our program this morning to help us decipher some of these mixed reports that we're seeing on the economy and what that means specifically to Midwestern job growth. We are honored to have speakers from Loyola, Chicago State, Kellogg, Ohio State, DePaul, University of Illinois, and Booth, as well as the Cook County Bureau of Economic Development. This is kind of our own version of the Elite Eight and kind of ACG's kickoff to March Madness, so fill out your brackets after the people have concluded their presentations. So, it is my honor to announce our first speaker. I'm Dustin Weinberger, by the way. I failed to mention that. I'm with GE Capital. And GE has a partnership with Ohio State University and its Middle Market Forum, which is a great conduit for developing research around the middle market, which is a lot of our focus here in this room. We're interested in middle market job growth. Professor Anil Makhija holds the Dean's Distinguished Professorship in Finance at the Fisher College at the Ohio State University, where he has been on the faculty since 1999. In the past, he has chaired Fisher College's Department of Finance, served as an Associate Dean, and held the David A. Rissmiller Professorship in Finance. Professor Makhija's research and teaching interests are in the field of corporate finance and focus on issues relating to capital structure, corporate governance, and utilities. Recently, he was awarded the Best Paper Award at University of Michigan's Mitsui Conference for his co-authored work on the relationship between CEO, personal, and corporate leverage. Professor Makhija is the recipient of numerous teaching awards. Executive MBA classes at Fisher have chosen him for their Outstanding Faculty Award for 8 out of the last 9 graduating classes. During Professor Makhija's tenure, the finance department at Fisher ranked among the top 10 or top 20 in comparison of finance departments internationally. Professor Makhija has participated in consulting or executive education programs in the U.S. and abroad for dozens of organizations. He received a PhD in finance from the University of Wisconsin-Madison, an MBA from Tulane University, and a bachelor's degree in chemical engineering from the Indian Institute of Technology in New Delhi. Please join me in welcoming Professor Anil Makhija. There we go.
Thank you, Dustin. And another good morning to all of you. It's my pleasure to share with you the findings of our National Center for the Middle Market. This is a collaboration between GE Capital and the Fisher College of Business at The Ohio State. We are dedicated to the study of middle markets. So let me not be presumptuous and lay out what is our definition of the middle market before I share with you what we believe this very important segment is telling us about the economy. The definition that we have used for the middle market is indeed controversial, is 10 million to 1 billion. Now that's a very large territory. And in fact, when we study it, we divide it into three parts, 10 to 50 million, 50 million to 100 million, and from 100 million to a billion. Clearly, at the lower end, we are talking about small-like behaviors, and at the upper end, we are talking about large-like behaviors. But in the process of looking at this, we believe that you get a very comprehensive view of what the middle market is. Surely, there are other definitions which are viable. The Small Business Administration has different cutoffs, something like 7 million, something more or less, depending on the different industry. And sometimes they don't even look at revenue, they look at number of employees. But if you invoke our definition, you would find that roughly in the US economy, there are about 200,000 firms that fall in that range. Now, to put that in perspective, less than 10 million, the lower bound, there are about 6 million firms. Above the 1 billion in the economy, roughly there are about 2,000 firms. The interesting thing about the lower end is that perhaps because of their large numbers, and also I think small firms do deserve our attention because they are well known to be centers of innovation, they get a lot of attention. The Small Business Administration is formal advocacy for the small firms. Large firms have deep pockets, they are in the public eye, and I think they are able to take care of themselves. In between lie the 200,000 which typically don't get much attention. And it is that 200,000 that I'm going to emphasize right now. I think it is the group that you worry about. It's the group that the center, the National Center at the Middle Market at Ohio State worries about. Now, what is the role of these 200,000 firms? Why should we worry a lot about this roughly 3% or less of all the firms out there? Well, one reason to worry about them is that these firms explain roughly 1/3 of the non-government GDP. They also contribute about 1/3 of the private sector jobs. So what happens to the US economy, in some sense, can be gauged best by this very important segment of the economy. But it's not just that they are a major proportion of the economy, they also are, I believe, better representative of what is truly going on in the country. How so? Well, if you think about geography, you know that most of the large firms are headquartered in the Northeast. If you think of small firms, there is a bit of a preponderance of small firms in the Southeast. But if you look at the distribution of middle market firms, you will see serious representation in every geography of the country. So if you want a barometer of what is happening in the country, I think you're well advised to look at middle market firms. Similarly, if you want to think about industries, there is a general, more significant spread of middle market firms across various verticals, so that if you want to get a sense of the economy across industries, again, middle markets is perhaps a desired barometer. So with that introduction, what does the middle market tell us? One of the things that the center does is that it brings out a quarterly middle market indicator. And this indicator is based on a survey. Why? Because one of the reasons that the middle market has not been studied a lot, and many of you are well aware of this in being involved in private equity in other ways, is that the middle market is predominantly privately held firms, family, private equity, etc. So as a result, the light is not on them. There is no SEC regulation requiring many of these firms to disclose. So consequently, there isn't the same kind of information. And it's easy for academics and others to search where the light is, which is where the SEC filings are. Okay? So consequently, the only way to come to know what is going on is to actually do a survey, and that's what we do every quarter. So this is the nature of our survey. We talk to about 1,000 CEOs or C-level executives in the middle market. Furthermore, that this group is developed as a representation to the national population of the middle market. So we make sure that the revenue categories are covered, that the geographies are covered, that the industries are covered, so that this is truly representative. So the last survey that we did was for Q4, the fourth quarter of 2012. So this was conducted from May 5th onwards, December 5th onwards, for about 10 days or 2 weeks. And by the way, the next one is in field right now, and we will be disclosing our next quarterly results, Q1 for 2013, on April 24th at the ACG national meetings. And which is what we did last year also, that we disclosed the most recent quarterly results. So the next one is coming soon, but this is the latest that we have before the next quarterly report. So let me very briefly first give you some summary view of what the results are showing. Then I'll go into some details, and hopefully there'll be some interesting details about how exactly the economy is evolving. So the first thing to note is that after 3 quarters of Q1, Q2, and Q3 in 2012, the market had a turnaround, the middle market had a turnaround in its revenues. So if you looking 12 months back, looking the year back in Q1, revenue had grown for this segment at 6.9%. In Q2, looking back, things had deteriorated slightly, 6.1%. If you look further, Q3 of last year, slight further deterioration, 5.5%. But the last quarter was a turnaround, and the turnaround was that revenues for the middle market grew by 7%. And I'll come back and put this in more perspective relative to growth of the other components of the economy, et cetera. But what I want to highlight here in a summative fashion is that the middle market is seeing, already it was seeing growth, but declining rates of growth is seeing higher growth, respectable 7%, and at the same time a turnaround. In terms of confidence, and these are some of the conflicting kinds of items that Dustin was also highlighting, the confidence generally in the middle market remains low when you think in terms of confidence in the global economy, if you think about confidence in terms of the US economy, but somewhat stronger in terms of the local and regional economy. And it's improving slightly as well. And so I'll give you more details on that as we go along. One of the interesting questions I think we ask is, if you were given an additional dollar, what would you do with it? And we give several options. Important among those options is we ask, would you, for example, want to hold it in cash or in short-term securities? Or would you invest it? And if so, how so? 41% of the respondents in this fairly decent 1,000 sample would like to hold on to that dollar in the form of cash or in the form of short-term securities. Meaning that this is a lot of capital not going into investment. And I'll later talk about the types of investments where it does go when it does. So this is a fairly low confidence in terms of investment, but on the other hand, I'll show you this is actually a slight improvement to what things were earlier in 2012. Well, while I refer to the improvement in revenues, I should also point out that challenges remain. On the top of these challenges is healthcare costs, as we are all trying to figure out how ACA, Affordable Care Act, gets rolled in. There is also concerns about maintaining margins, but also about uncertainty of government action. And that's another item that was referred in the introduction this morning. And I'll come back to this in some more detail, both about feelings about the healthcare costs and also about potential government's adverse actions for the middle market. And mind you, the middle market, compared to the small and the large, doesn't manage to manage regulations as well, because it doesn't have the advocacy of the Small Business Administration or the deep pockets. So for example, Sarbanes-Oxley has exemptions for small firms. Large firms have economies of scale. Guess who gets per dollar the highest cost of regulatory burden in that case? Finally, in terms of hiring, the middle market during these difficult periods has actually continued to add jobs. And in the last 1 year, 12 months, going back from December of 2012, we estimate, and I'll show you some details, that they added about 1.17 million jobs and are predicted to add nearly 1 million jobs going forward. And now on to some details. So before I go on, I might add that overall this paints a picture of some improvement, but on the other hand, you hear of all the concerns about government action, healthcare costs, the confidence issues. My summative statement is that this important segment of the economy, good barometer for the economy of the country, is showing what I would call cautious optimism. Meaning this is the kind of turnaround to growth that can be jeopardized very easily, perhaps by some regulatory or other costly government action. So in terms of the economic outlook, you can see how the economic outlook is slightly improving. 33% of the middle market has confidence in the global economy, concerns about Europe, at the point some slowdown in China, in India, so that there was good reason. And you can see it's fairly low. Now, of course, middle markets, unlike large firms, also don't have a large footprint in the global economy as well. They have somewhat more in the US economy where they do show more confidence, but that's only about half the people showing some confidence. I wouldn't rate that very high either. Finally, they are most embedded in the local economies. In fact, I refer to middle market firms as the pillars of their community. They have, by the way, middle market firms have astounding longevity. Small firms on average last only about 7 years. Large firms, of course, last a long time, like 37 years average. This is Dun & Bradstreet data. But do you know that middle market firms last an astounding 31 years? So they provide very stable jobs. They are pillars of the local economy. And they are embedded, unlike the multinationals, in their economy. So as I already mentioned some of these challenges, there is the cost of healthcare, which is showing up quarter after quarter, by the way, on the top as the concerns. Understandably, during this period, we saw a lot of increase in commodity costs. So consequently, there's also the question of ability to maintain margin. Cost of doing business, you could say, relates back also to government regulatory costs, such as cost of healthcare. And you see the uncertainty of government action as well. What you also see, by the way, and this shows up repeatedly, is on the one hand, we see a lot of unemployment, as was referred to at the start here. But at the same time, when I speak to middle market managers, the common refrain is, I can't find the right people. Okay? And this is a major concern, I think, for the US economy, whether we have now fallen into a structural problem with talent management. Lots of people, but not the right talent for the right jobs, as the world economy has become more aggressive and changed in many ways, requiring more skills than ever before. As I told you that when it comes to healthcare, that is a major area of concern. So you can see that about 50% on all segments of the middle market, people are looking at what they should be doing. There are even people who are willing to eliminate coverage and simply pay the fines. There's a lot of talk about this kind of a group. Actually, among the middle market, it's not such a big group. As you can see, that will pay fines and eliminate coverage runs between 6 to 11%. And so this has often been kind of pointed at the middle market and said, they want to walk away from responsibility. Not so. And by the way, does healthcare cost land up affecting business? Of course it does, because it raises the cost of doing business, and it adversely affects your margins. And as a result, you kind of step back from investments that you might have been thinking about making. And only about 1/3 of the firms say that they will not be impacted. So that's a fairly large percentage of firms that are getting affected by healthcare costs. And you can see it in terms of hiring freezes, laying off workers. So on the one hand, we are hoping for better employment situation, but we are not exactly helping it with our regulatory scenes on the other hand. Again, on the revenue growth, I want to highlight the turnaround, where the experience, the actual revenue going 1 year back had been dropping, has shown a turnaround, and no wonder, I think the stock market in January, as a reflection of this kind of a turnaround, has already shown some adjustments. Mind you, the Standard & Poor's in Q4, looking back, was way behind the middle market. It had grown by only 2.9%. This is looking forward, perhaps more important than where we came from. And you can see that our expectations, now the middle market tends to be conservative in its forward-looking. So I showed you what was the actual revenue. This is roughly 70 to 75% of whatever they experienced, what they were predicting forward. This is not kind of random walk where what you just felt is your best prediction going forward. Rather, this is a conservative market going forward. At this point, even though the experienced revenue was like 7%, cautiously they expect going forward it would be 5.2%. And by the way, that's stronger than the large because the average for the S&P 500 is 3.5%. Which industries are showing this? Clearly, we are a service economy, so when the economy improves, you will automatically see the service. It has done well in the recent 12 months and is predicted to do relatively well going forward as well. Let me add that the other one that jumps up is construction. And again, the introduction this morning pointed to housing, which is perhaps behind the construction, which has seen improvements and continues to be among the leaders going forward as well. Job creation. The middle market has continued to add jobs. Might I remind you that we even went and looked at the Great Recession that we came through from 2007 to 2010. And the middle market actually added jobs during that period. This, as you remember, was a period when large firms were shedding millions of jobs. Recently, it has grown by 2.7%, and comparing it to ADP data on what the other segments have done, large corporations grew by 2.1%, and small firms by 1.2%. Look, small firms do deserve our attention. But I think there is a bit of a myth going on that it is merely the small segment that creates jobs. And it's understandable where that comes from. When you look at 6 million firms, you like to think that small additions by them would create lots of jobs. But in reality, the middle market has actually outstripped job creation in the recent past. And looking forward as well, you can see that the middle market will continue to add jobs. We don't have a comparable expectation figures for small and large. This 2.3%, given the size of the middle market, translates to roughly 1 million more jobs in the coming 1 year. This question about what would you do with the additional dollar, as I pointed out, 41% of the respondents would hold it instead of investing it. And that's a slight improvement from 44% the quarter before and 49% the quarter even before. Yes, there is improvement in the investment scenario, but I would overall say 41% of the people not investing is something to be concerned about. And where does this money go? Well, you can see a little bit clearly in terms of plant and equipment, in terms of capital expenditures, but otherwise it's kind of thrown around in different pieces, whatever investment is taking place. So there isn't a kind of a big pattern. Slight pattern in terms of more M&A and acquisitions taking place at the higher end, the 100 million to 1 billion for the middle market. And now in closing, just a couple of slides to tell you about what is the effect of uncertainty. Now remember, December 5th to December 11th or 12th, roughly in that week or 10-day period when this survey was in the field, we were in the throes of our discussion about the fiscal cliff. Of course, that one problem is gone, but now we have sequestration, and then we have perhaps the debt ceiling, coming up. So there's a kind of a sequence of issues. But that was the issue at the point in time. And so we asked people, there's uncertainty. Now, mind you, many of the smaller end of the middle market firms would be perhaps S corporations. Now, S corporations means that whatever is lost in profitability and whatever rather goes up in taxation is actually going to reduce the take home for the owners. A lot of these are privately held firms, family firms. So as a result, this may in fact reduce investment. So consequently, we asked that question. And indeed, the average reduction in investment was about 4.8 or roughly 5%. It was costly. That uncertainty is costly. We also asked about the access of capital. And here we don't see much happening. And I think it's largely because of what I said earlier. So many of these firms are sitting on so much hoards of cash that access to capital isn't the top of mind issue for them. But by the way, this may also be the reason that in the coming year, if the economy does continue to improve, you will see a whole lot of M&A happening as firms begin to take a more proactive investment stance. And did the fiscal cliff, what would be the preferred, outcome for that? I know this is kind of gone now, but clearly you can see that reduction of deficit, because typically when government is trying to finance the deficit, there is a sort of a crowding out effect for the rest of us who want to borrow. So those might be the kind of reasons behind these preferences, besides just not wanting to have to pay more taxes. And a final observation, is that the end of uncertainty? Not at all. 85% of the respondents say, yeah, even if you resolve the issue of fiscal cliff uncertainty, there is plenty of other problems coming up ahead. So that's what I have for you. Improving environment, lots of challenges, cautious optimism, and you're welcome to read the longer report, full report, and all the subsequent ones. middlemarketcenter.org, very easy to remember, and we have lots of reports about the middle market, and I know that's a market you care for, so come join us, give some attention to this long ignored central component of our economy. Thank you.